we're recording this on the 9th of April. So there's been a little bit that's happened since the end of March, but reflecting on what actually happened in the March period, it was a bit of an expectation setting of preparing for what was called or termed Liberation Day on the 2nd of April. Markets were negative if you look at equity markets. So the Australian market was down around that 3.5% level. The more economically sensitive markets were down a bit further, and the US market again was down further again. So the US markets were off sort of 5 to 5.5% in the month. Yeah, so if you think of diversification across portfolios, so equities were down, and because bond yields have been higher and cash rates have been higher, they actually have provided a ballast in portfolios in this latest bout of initial volatility. So that means that yields have compressed, so they've been reducing through the period as investors sought a bit of conservatism being added into portfolios and added some defensive assets. So that was positive for fixed interest assets. Yeah, so normally we'd go into a bit more detail on what happened in March. It's probably less of an issue now. It's more looking at what's actually happened at the start of April. The Trump tariffs that were announced were in some ways larger than what was expected and probably quite pervasive across most economies and most countries, which was a little bit of a surprise. And there's obviously now, since they've been announced, a bit of tit for tat. So that was, I suppose, some of the really stern words coming through from policymakers in the US was, this is what we believe we should be putting in place to return global trade back into more of terms that are favorable for the US. And if you seek to rebut those or retaliate to those, we will go harder. I think the expectation was that they'd be a little bit more open to negotiation. They are probably still open to negotiation, but clearly they're putting a really firm position out there that the tariffs are what they are, and they're now effectively in effect. And it's something that markets are still trying to grapple with. Yeah, anything like this creates uncertainty around how it will impact consumer behavior, uncertainty then obviously of what that means for businesses and whether that's going to mean that they'll be able to pass on that increase of tax and increase of cost into how they run their business. Obviously a bit of uncertainty then economically as to how economies grow with that consumption uncertainty. It has been more volatile since the tariff announcements, which has been a bit of a flight back into the safe haven currencies of the US, the Swiss, the Japanese currencies, which are typically a move that markets make to put a more conservative position into portfolios. Clearly, we need to put all of these pullbacks in context. So it can be quite alarming if you're closely watching markets, and we'd certainly encourage clients not to do so over the medium to longer term, which is typically, we're setting up investment plans for no less than 5 years in most cases, if not 15, 20, 25 years, depending on ages of clients and health and those sorts of things. So when you think of bouts of volatility that happen almost instantaneously. These markets move so quick. Things move within fractions of seconds based on words and based on algorithmic analysis of what's being said. Now, that, as I said, can be disheartening and challenging to deal with, but if you put it into a long-term perspective, so even 1 year number, for many equity investors, those that have been in the market for at least a year, you're probably still flat, if not a little bit higher, based on which day you're looking at the markets and how much they move in the next few days. But we're still, in many cases, probably positive. And certainly, this is, we talk fundamentals and we talk diversification as being a core principle in investment and portfolio construction. Other assets, if you take your mind away from equity assets, if you look at infrastructure, if you look at bonds and fixed interests, you look at cash, those assets have probably held up relatively well. While it's difficult to, but turn off the headlines. Yeah, don't read into the newspaper headlines and get caught up in the negativity of what the announcements and headlines are. You know, you can doom scroll, as they say, in social media or even in the mainstream media, and get really caught up in emotional reactions to what's going on. Um, yes, there's an uncertainty with these announcements and what the implications are, but economies and businesses seem to find a way to muddle through this sort of stuff. And yes, there may be implications in terms of earnings outlooks or profitability outlooks or economic growth outlooks. But that's something that, you know, over a long-term journey, which many of our clients have got years ahead of them, not minutes or days or weeks, where they've got a longer term horizon. That's what you want to focus on and focus on what your money's being invested for and what the purpose of what you're trying to do with that money as well. Well, I think in the period ahead, it's probably a bit more uncertainty. So that will potentially be unnerving, but I think you've got to see volatility as an opportunity rather than as a risk. Yeah, so that's something that there will be advantage or there will be positions that you can take advantage of. There will be some opportunities that come up. We use a blend of different types of strategies within the portfolios that we advise clients to hold. So there'll be some passive positions, which will be typically the larger positions in economies or in markets, if you like. And there's some active managers that we use as well. And many of those would be looking across their portfolio, seeking to de-risk when there's a bit of a uncertain outlook, but then also looking for opportunities when they're confident that the sell down or pullback is giving those opportunities to get into better quality or higher quality businesses and opportunities or assets, even fixed interest as well. So that will be something that will be something that we'll have to contend with for a period of time. It is reporting season coming up in the US, so you know I don't see that we'll get too much clarity from that. It's too early to tell. I think many businesses probably don't know at this stage the extent of what the impact of what these tariffs will be, and you know, even if they get fully enacted as they are. Clearly, central banks will be watching this and monitoring closely. I think the positive sign for that is that rates are higher today than what they have been over the last handful of years. So, if economies do tend to slow down with these tariffs being announced and head into a bit of a slower period of growth, central bankers can move and they can cut rates. So that's maybe not so great for savers and those that have got deposits, but certainly it'll be stimulatory and it'll be positive for markets and positive for risk assets as well, if there's the requirement to do that. And I think the expectation is from markets now is that the rate cuts are more likely to happen this year and probably earlier through this year than what they had previously predicted, because there is uncertainty and probably because there is a bit of a handbrake on growth if the tariffs all fully get implemented.